See, today in this class, I will tell you how to post the accounting entries, right? This is very much necessary for you to understand. Accounting. Accounting is the systematic way of recording the business transactions to find the results from the business operations. Here, when you start the business, right, you will be incurring different business transactions. And obviously, we have to know the results of the business transactions and the business operations. So for that purpose, we have to record the business transactions in a systematic way, right? You cannot record these business transactions as you wish, right? But all the business transactions are to be recorded in a systematic way. So the systematic way of recording the business transactions is called accounting. So here there are only three types of accounts. You take any account, it will relate to one of these three accounts. Number one, personal accounts. Number two, real accounts. Number three, nominal accounts. See here, personal accounts. Personal accounts represents name of the persons, name of the organizations. Suppose, for example, Mr. Krishna account. It is the name of the person. Then Bharat and Company account. It is the name of the organization. So the name of the persons, name of the organizations are covered under personal accounts. Similarly, capital account is also a personal account because it represents the owner of the business. Always the capital is contributed by the owner of the business. Then bank account representing the bank and organization. Means here HSBC Bank, it's a banking organization. HDFC Bank, it's a banking organization. Citibank, it's a banking organization. Like that, the name of all the persons and organizations are covered under personal accounts. So according to personal account principle, what we have to debit and what we have to credit is accounting principle. Debit the receiver, credit the giver. This is a very important thing you have to remember. Whenever any account is covered under personal accounts, we have to debit the receiver and we have to credit the giver. This principle you have to remember. Then we have the real accounts. The accounts which represent the tangible aspects. Tangible aspects means the things which you can touch and which are the physical existence and which are the intrinsic monetary value. Those are called tangible aspects. See, for example, cash account is a real account representing the cash which is tangible. Similarly, goods account or stock account. Goods account means it may be a raw material, it may be a finished goods, it may be a packing material, it may be a stores and spares, anything. Goods or stock account. It represents the stock which is tangible. Similarly, furniture account representing furniture which is tangible. Furniture account is a real account. Goods account is a real account. Cash account is a real account. Building account is a real account. Land account is a real account. Vehicle account is a real account. So like that, all the aspects which you can touch, which are the intrinsic value, which are the physical existence, they are covered under real accounts. And one more thing, it's not a rule that the real account should have the physical existence, right? Just for the understanding purpose, I said it represents the tangible assets. Sometimes they may also represent intangible assets also. For example, take goodwill. You cannot touch the goodwill, but still it is asset for the company, right? So the cash account, goods account, furniture account, land account, buildings account, etc., etc. All these accounts are covered under real accounts. And the accounting principle is debit what comes in and credit what goes out. Again, this is the principle what you have to remember. So this is the thing regarding real accounts. Then we have the nominal accounts. These accounts represent expenses, losses, incomes and gains. So what is the difference between expenses and losses? If you spend something, right, and if you get something in return, That is called expense. Suppose, for example, take salaries. You are paying for the employee services. Means you are getting the services of the employees. So for salaries, what you are getting in return? The services of the employees. That is called expense. Then similarly, rent. You are paying for rent. In return, what you are getting? Services of the landlord. Means we are using the premises of the landlord. That is called expenditure. Then similarly, wages. You are paying the wages to your workers. In return, what you are getting? Services from the workers. Traveling expenses. You are paying for the transportation. In return, what you are getting? You have the facility to travel from one place to another. Like that, in the case of expenditure, you get something in return. Suppose if you don't get something in return, that is called loss. Suppose you are walking on the road, right? Then you lost some $100. That is loss. Clear? Then incomes and gains. Income means you get something, right? In return of which you render something. You get something in return of which you have to render something. For example, sales. You have delivered your goods in return of which you got the cash. That is called sales revenue. Suppose you have rendered some services to some outsiders. In the return, you will be getting some revenue. Right? Suppose for example, I am giving you the training, right? In return, I am getting the fees. This is my revenue or this is my income. So, if you get something with your efforts in return, that is called income. Without of your efforts, if you get something, that is called gain. You are walking on the road. You found $100 note on the road. Then it's your gain. So that is the difference between incomes and gains again. Here, accounting principle is debit all expenses and losses, credit all incomes and gains. So these are the three accounting principles you have to remember for the purpose of understanding how to post the transactions. Number one, personal accounts. Debit the receiver, credit the giver. Number two, real accounts. Debit what comes in and credit what goes out. Okay. Then nominal accounts. Debit all expenses and losses, credit all incomes and gains. Okay. Now, with the help of this, let us see how to post the transactions. See, for example, the business owner has introduced the capital. The business owner has introduced the capital, right? This is the one business transaction. Capital introduced, let us say $1 lakh. So this is the business transaction. Then how to post the accounting entry here? In this business transaction, what are the main aspects? Number one, capital, right? Number two, cash. Capital will be introduced either in the form of cash, obviously, right? Now, cash account is coming under real accounts, right? So according to real accounts principle, debit what comes in. So when the business owner introduces the capital, the cash is coming into your organization, right? And cash is covered under real accounts. According to real accounting principle, debit what comes in, right? So we have to debit cash account. So this is the traditional format. Cash account at or $1 lakh to Owner, share capital is nothing but owner of the business. So who is giving the capital to you? The owner of the business. That is capital. So we have to credit capital or we have to credit share capital. So share capital, $1 lakh. Right? Then this is one business transaction. Right? Suppose, for example, today we have paid salaries. This is one business transaction. Salary is paid $10,000. Then in this business transaction, right, what are the two aspects? In every business transaction, you have to find out two important aspects. Salary is paid 10,000 in cash. So here, what are the two aspects? Salaries and cash. So salaries account is covered under nominal accounts, right? And salaries is a expense. According to nominal accounting principle, debit all expenses, right? So we have to debit salaries account. Salaries account at or $10,000. Then paid in cash. You have paid salaries in cash. Means what? Cash is another important aspect of this transaction, right? So when you pay salaries in cash, the cash is going out of firm, out of your business organization. So cash is covered under real accounts. According to real account principle, credit what goes out, right? So cash account, 10,000, right? Then you have paid rent in cash. So rent account and cash account. These are the two important aspects in this business transaction. Rent is covered under nominal account principle, nominal accounts. According to nominal accounts, debit all expenses. So rent account is debited. Then when you pay rent in the form of cash, right? Cash is going out of your firm. Cash is going out of your organization, right? In that case, cash account is to be created. So rent account is to cash. Okay. Suppose goods purchased for cash. This is another business transaction, right? So in this business transaction, what are the two aspects? Goods and cash. So goods and cash both are coming under real accounts, right? So when you purchase the goods is coming into your organization. Goods means here raw material or packing material or stores and spares. So here when the goods are coming in, right, we have to debit goods account. Particularly speaking, if you purchase the raw material is coming into your organization. So raw material account is debited. If you purchase packing material is coming into your organization. So packing material is to be debited. So if you purchase stores and spares account is to be debited. Right? So in the general sense, goods term, if you purchase the goods, in the general sense, goods account is to be debited. But particularly, if the goods is raw materials account is to be debited. If that goods is stores and spares account is to be debited. If that goods is packing material account is to be debited. As simple as that. Right? So let us assume that goods here stands for raw material, right? So when you purchase the raw material is coming into your organization. So raw material account at or $2,000 to cash. So you are paying for the raw material in cash. So cash is going out of your firm. So cash means it is covered under real accounts, right? So to cash, 2,000. That's how the purchase entry is made. Now Another business transaction. Raw material purchased from ABC and Company for $4,000. This is called credit purchase. If you pay the cash immediately, right, that is called cash purchases. If you pay cash after some time, that is called credit purchase. So here we have purchased raw material from ABC and Company for $4,000, and ABC and Company said you can make the payment of $4,000 after 10 days. This 10 days is called credit period. So this is called raw material purchase on credit or credit purchases. So in this transaction, there is no involvement of cash, right? So what are the main two aspects in this transaction? Raw material and ABC and Company. Okay. So raw material means goods. Goods means real account. When you purchase the raw material is coming into your organization, right? So according to real account principle, debit what comes in. Raw material account at all 4,000, and ABC Company is the personal account, right? So according to personal account principle, credit the giver. ABC and Company is giving you the material, right? So ABC and Company is called giver to ABC and Company. $4,000. Okay. This is how the credit purchase entry is posted. Now, you have paid $4,000 to ABC and Company towards the material he has supplied, right? That is another business transaction. Cash paid to ABC and Company. So in $4,000. So in this business transaction, what are the main two aspects? ABC and Company and cash. So ABC and Company means personal account. When you pay cash to ABC Company means ABC Company is the receiver, right? So according to personal account principle, debit the receiver. Who is the receiver here? ABC and Company. So ABC and Company account at or $4,000, and cash is the real account, right? And when you pay cash to ABC, cash is going out of your firm or going out of your organization. So cash account is to be credited because the principle is credit what goes out. So to cash, $4,000. This is one business transaction. Suppose if you make the payment to ABC and Company through check. In this case, if you issue the check to the ABC Company means ABC and Company is receiving the payment. So ABC Company is the receiver. According to personal account principle, debit the receiver. So when you issue the check, bank, suppose you have issued the check from HSBC Bank. HSBC Bank is giving the payment to the ABC Company on your behalf. In this case, who is the giver? HSBC Bank. Then HSBC Bank is to be created in the case of cash account. In the place of cash account. Again, I am repeating. If you issue the check to the ABC and Company, right? ABC and Company is the receiver, right? So ABC and Company is to be debited. Then you have issued the check from HSBC Bank. Means the HSBC Bank will give the money to ABC and Company on your behalf. Means HSBC Bank is the giver. HSBC Bank means it's also a personal account. So credit the giver, HSBC Bank. Now, suppose for example, You have sold goods. Sold goods for $10,000 for cash. For cash. Okay. Now, in this case, in this business transaction, what are the main aspects? Cash and goods. Goods means finished goods. So when you sell the finished goods, see here, goods is the real account and cash is also the real account. So when you sell the finished goods, goods are going out of your firm. So goods account is to be credited, right? And you are getting cash. So cash account is to be debited. So here goods means finished goods, right? Then the entry is cash account debtor, $10,000 to goods account. See, in the business terminology, instead of goods account, right, we credit sales account, nothing else. Instead of goods, we credit the sales account. Similarly, when you purchase the material, instead of materials, you can debit purchases. Clear? This is the case when you sold the goods for cash. Suppose, sold goods to PQR and company. Sold goods to PQR and company for $25,000. So here the important aspect is PQR and company. PQR and company is the personal account, right? And goods means sales, right? Goods means real account. So here PQR and company is the receiver. According to personal account principle, debit the receiver, right? So PQR and company account debtor, say $25,000 to goods account. As I said, instead of goods, you use the sales. $25,000. That's it. This is called credit sales. So from whom you have to receive the payment? From PQR and company. Right? Now, PQR and company has paid 25,000 to you. In that case, payment received from PQR customer, $25,000. In this transaction, what are the main aspects? Payment received from PQR means cash you have received from the PQR. So cash account and PQR and company, right? So cash account is under real accounts. So when you receive the cash, you are receiving the cash is coming into organization. So debit the cash account because debit what comes in. Cash account debtor, $25,000 to PQR and company is the customer and PQR and company is the personal account. When the PQR and company pays to you, he is the giver. So according to personal account principle, credit the giver, PQR and company. That is 25,000. Suppose if your PQR and company has paid only part payment of 15,000, same. You debit the cash account, you credit the PQR and company, but with 15,000 amount. So these are the business transactions. These are the very frequent business transactions what I have covered in this session. Okay, and if you have any questions regarding the posting accounting entries, right, you can ask me in the class itself, in our regular class itself. Okay, okay then, thank you.